You are 23 years old. You have $11,200 sitting in a high-yield savings account. Both versions of you start here. This is where things divide. Path A, the buyer, age 23. Your paycheck lands at $3,140 after taxes. You work in project coordination at a mid-sized healthcare company. The office has glass walls. The coffee machine makes the same grinding noise at 8:04 every morning, like it's on a timer. Your manager is Carla. She's direct, organized, and fair. You've been learning about real estate since you were 21. Not obsessively, deliberately. You understand debt-to-income ratios. You know what PMI means. You keep a spreadsheet labeled house fund. Every month, $800 moves into it automatically the morning after payday. It goes into a high-yield savings account earning 4.7% APY. You don't feel the transfer because you set it up not to. Your rent is $1,180. One bedroom. Thin walls. A parking spot you compete for with the guy in 4B. It works. It's temporary. That's the word you use, temporary. By the end of year 1, the house fund reaches $10,400, plus interest. Total, $10,617. Path B, the investor, age 23. Same city. Same job type. Same $3,140 after taxes. Your rent is $1,240. Slightly better unit. 2 roommates left 6 months ago, and the landlord never adjusted the price. You stayed. You're not saving for a house. You considered it. You ran the numbers. You read a detailed breakdown on a personal finance forum. Mortgage, PMI, taxes, insurance, maintenance, opportunity cost. You bookmarked it. You came back to it 4 times. On the last visit, you decided. You open a Roth IRA. You contribute $500 a month. The first deposit feels strange. The balance says $500. It looks insignificant, almost like a parking fine. That same evening, you open a taxable brokerage account. Another $300 per month. Total market index fund. Expense ratio, 0.03%. Both transfers are automated for the Wednesday after payday. By Thursday, you're not thinking about them anymore. At the end of year 1, the Roth holds $6,200. The brokerage sits at $3,700. The market moved unevenly that year. It didn't matter to you. Path A, the buyer, age 24 to 25. At 24, you get a raise. $4,800 annually. Your monthly contribution increases from $800 to $1,100. Nothing else changes. You start visiting open houses on Saturdays. Not to purchase, just to understand. At a Colonial on Heron Drive, you meet a real estate agent named Thomas. He shakes your hand and says, "First time?" You nod. He hands you a folder divided into sections. You read every page sitting in your car afterward. You learn about closing costs, typically 2% to 5% of the purchase price. On a $295,000 home, that's between $5,900 and $14,750. That number wasn't in your spreadsheet. You open it and add a new column labeled closing. You revise your target. You learn what a radon test costs. You understand inspection contingencies. You learn how an appraisal differs from an assessment. You store each detail carefully. By 25, your house fund reaches $38,400. It's not enough yet. Your goal is a 20% down payment to avoid PMI, plus closing costs on a $300,000 home. That puts your required cash near $72,000 at closing. You adjust your timeline. 1 more year. Path B, the investor, age 24 to 25. Same raise. Same $4,800. You increase your brokerage contribution to $500 a month. The Roth stays at $500. Total monthly investing $1,000. You update your spreadsheet. Then you close it. In month 7 of year 2, the market drops 14%. Your brokerage falls from $18,400 to $15,800 in 3 weeks. You reread a line you saw when you started. Time in the market beats timing the market. It sounds cliché because it had to survive reality. That month, you invest an extra $400. That's the full extent of your boldness. By 25, your Roth IRA holds $24,600. Your brokerage account reaches $18,900. Total invested, $43,500. The market recovered and moved higher. One afternoon, a coworker named Derek shows you a listing on his phone. $312,000. 3 bedrooms. A fenced yard. You look at it. You don't feel regret. You feel interested. Position at age 25. Path A. House fund, $48,200. Cash outside fund, $3,100. Investments, $0. Net worth, $51,300. Path B. Roth IRA, $24,600. Taxable brokerage, $18,900. Cash, $6,800. Net worth, roughly $50,300. On paper, the numbers look almost identical. The structure underneath them is not. One pool of money is liquid, spread across thousands of companies in dozens of countries, quietly compounding. The other is assigned, waiting to be exchanged for one property in one location. They are about to turn into very different things. Path A. The buyer, age 26. You close on a home in March. 3 bedrooms. 1.5 baths. 1,640 square feet. A suburb about 20 minutes from downtown. The second bedroom has a ceiling fan that wobbles slightly. You notice it the first night. Then you stop noticing it entirely. Purchase price, $298,000. Down payment, $59,600. Closing costs, $10,400. Total cash required at closing, $70,000. The house fund is no longer a fund. It's a house. Your mortgage officer is Phil. He locks your rate at 6.7% on a 30-year fixed loan. Monthly principal and interest, $1,552. Property taxes, escrow $380. Homeowner's insurance, $130. Total monthly payment, $2,062. Your previous rent was $1,180. The difference, $882 per month. The night you get the keys, you walk through every room. The kitchen tiles are dated. The yard is overgrown. You don't mind. Furnishing the house costs $6,800 over 4 months. A couch. A dining table. Bed frame. Blinds. Lawn mower. And one unexpectedly expensive trip to the hardware store for an issue the inspector mentioned but never priced. You create a maintenance reserve, 1% of the home's value annually. $2,980 per year. About $248 per month. It sits in a separate savings account labeled simply, House. You read that this is the correct approach. So you follow it. Total monthly housing cost, $2,310. You pause all investing. The numbers don't support it right now. The plan is to resume in 18 months, once things stabilize. You write that plan down. Path B, the investor, age 26. You don't buy. Your landlord raises the rent to $1,320. You negotiate it down to $1,280. Here's what matters. Path A deployed $70,000 all at once. Your version, the money invested since age 23, has grown. $43,500 in contributions plus $7,200 in gains. Total, $50,700 working for you. The $882 monthly difference in housing costs. You invest $700 of it. The remaining $182 covers renter-specific expenses. Renter's insurance instead of homeowners. No maintenance reserve. And a storage unit costing $87 per month for what would have gone into a garage. Your monthly investing increases by $700 on top of the existing $1,000. New total: $1,700 per month. This number isn't accidental. It's deliberate. Path A, the buyer, age 27 to 29. Month 8, the water heater fails. Replacement cost, $1,100 installed. Paid from the maintenance reserve. That's what it exists for. You refill the reserve over the next 3 months. You restart investing at 28. 18 months became 22. The budget needed more time. You enroll in your company's 401k, contributing exactly 4%, the full employer match. The company adds another 4%. There's only one way to think about that. You don't leave free money behind. Monthly retirement contributions: $248 from you, $248 from your employer. Total, $496. At 28, your home's estimated value rises to $317,000. 2 nearby sales support it. Mortgage balance, $238,400. Equity, $78,600. That includes your original down payment, principal paid down, and about $19,000 in appreciation. A neighbor, Carmen, mentions selling her place for $329,000. Similar size. You store that number. By 29. 401k, $22,400. Home equity, $91,200. Net worth, approximately $121,000. Most of it is illiquid. The equity exists, but accessing it means selling or borrowing. Meanwhile, your friends who rent have dealt with 3 increases in 3 years. Your housing payment hasn't changed since the day you signed. Path B, the investor, age 27 to 29. At 27, your income rises to $72,000. For the first time, you max out your Roth IRA. Annual contribution, $7,000. The brokerage continues at $700 per month, plus the housing differential. Total annual investment, about $22,400 flowing into the market. At 28, you meet with a financial planner. Her name is Dr. Anaya Solis. She's fee only. $250 for a 1-hour session. She operates under a fiduciary standard. She says something you write down word for word. Past performance, whether in stocks or real estate, does not guarantee what either will do next. What I can offer you, she says, is a way to stay resilient across different outcomes. Certainty was never the goal. You run 3 projections together: conservative, baseline, and stress tested. In 2 of them, your portfolio outpaces the typical homeowner's equity growth through age 38. In 1, housing accelerates so aggressively that it doesn't. You continue investing. Resilience, not prediction, was always the framework. By 29, your portfolio looks like this. Roth IRA, $68,400. Taxable brokerage, $89,200. 401k, $18,600. Total invested, $176,200. You're still renting. You don't feel the need to explain that to anyone. The gap at age 29. Path A. Home equity, $91,200. 401k, $22,400. Net worth, $121,000. Housing consumes 73% of take-home pay. Path B. Portfolio, $176,200. Net worth, $183,000. Rent, 40% of take-home pay. Flexibility intact. The difference is $62,000 in net worth. But the structure matters more than the number. One is concentrated in a single, illiquid asset tied to one market. The other is spread across thousands of companies in multiple economies. They are different forms of wealth. They're not meant to look the same. Path A. The buyer, age 30 to 35. At 30, you refinance. Rates fall to 5.9%. The process takes 6 weeks and costs $4,200 in closing fees. New monthly principal and interest, $1,488. Monthly savings, $64. Break-even point, 65 months. You plan to stay. The math holds. At 31, you're promoted. Salary, $88,000. Your 401k contribution increases to 10%. Employer match remains at 4%. Annual retirement contributions, $12,320 from you, $3,520 from your employer. At 33, you consider expanding the house. A contractor named Joel walks the property and quotes $74,000 for a primary suite addition. You thank him. You don't follow up. The house is sufficient. The price isn't. Then the neighborhood shifts. A grocery store opens on Meridian. A cafe follows. Then restaurants with exposed brick and outdoor seating. Home values on your street rise 18% in 14 months. You order 2 appraisals while exploring a HELOC you ultimately decide against. Both place the home at $381,000. Equity, $174,000. Mortgage balance, $207,000. At 34, you open a taxable brokerage account. $400 per month. It feels late. It isn't late. It's later. That's different. By 35. Home equity, $191,000. 401k, $97,400. Taxable brokerage, $9,800. Net worth, approximately $298,000. The house dominates your balance sheet, over 60% of total net worth. You're aware of that. You're not entirely sure how you feel about it. Path B. The investor, age 30 to 35. Same promotion. Salary, $88,000. Your investment rate increases immediately. You max your 401k, $23,000 annually. You max your Roth IRA, $7,000. Your brokerage receives $1,400 per month. Total annual investment, $46,800. At 31, you move cities for a better role. Salary, $97,000. Rent increases to $1,620. You analyze buying again. The price-to-rent ratio in this market is 28. You remain a renter. At 32, your portfolio crosses $300,000 for the first time. You see the number on your phone during a meeting. You close the tab and return to the conversation. At 34, someone at a dinner asks if you regret not buying earlier. You respond, "I haven't run out of time." You mean it exactly as you say it. By 35. Roth IRA, $148,000. 401k, $172,000. Taxable brokerage, $198,000. Total portfolio, $518,000. Cash savings, $28,000. Net worth, approximately $546,000. The gap at age 35. Path A. Net worth, $298,000. Primary asset, home equity. Path B. Net worth, $546,000. Primary asset, diversified investments. Distance, $248,000. But the spreadsheet doesn't capture everything. Patha has a fixed housing cost that hasn't increased in 9 years and won't for decades. That stability is structural. It doesn't show up neatly in a net worth column. Path B has $518,000 compounding. At a 7% real return, that portfolio grows by roughly $36,260 this year without adding another dollar. That's structural too. They are different forms of reality. Both are real. Path A, the buyer, age 36 to 40. At 37, an inheritance arrives. $44,000. From a grandparent who kept her savings in certificates of deposit and rarely spent what she accumulated. You don't upgrade the house. Every dollar goes into index funds. The brokerage account begins to accelerate. By 38, your salary is $96,000. Your monthly investment rate outside the 401k reaches $1,800. It took until 38 to get there. You're on a different trajectory, not a failed one. At 39, you order 2 appraisals while seriously considering a HELOC this time. Both come back at $421,000. Mortgage balance, $178,000. Equity, $243,000. By 40. Home equity, $261,000. 401k, $189,000. Taxable brokerage, $64,400. Roth IRA, $31,200. Net worth, approximately $556,000. Monthly housing cost, $1,810. That includes the refinanced mortgage, taxes, insurance, and maintenance reserve. Friends renting similar homes are paying between $2,200 and $2,600 per month. The gap has reversed. You are now paying below market for comparable housing by a noticeable margin. Each year, inflation pushes rents higher. Your payment stays fixed. Quietly, the advantage compounds. There are 18 years left on the mortgage. Then it disappears. After that, housing costs drop to property taxes, insurance, and maintenance. Roughly $710 per month. That number reshapes retirement math in ways most charts don't reflect. Path B, the investor, age 36 to 40. At 36, your portfolio crosses $600,000. You hire a fee-only planner, Marcus Chen. Cost, $4,500 per year. Worth it. He recommends a small adjustment. Slightly more bonds, slightly less international exposure. You make the change once. Automation continues. At 38, your rent is $1,780. It has increased 5 times in 7 years. Each increase came with a 60-day notice. 1 year, you run the numbers on buying in that city. The price-to-rent ratio is 31. You renew your lease. By 40. Roth IRA, $248,000. 401k, $394,000. Taxable brokerage, $412,000. Total portfolio, $1,054,000. Cash savings, $34,000. Net worth, approximately $1,088,000. Your invested assets cross $1 million before your 40th birthday. There is no celebration. The number appears on a Monday morning. You have a 9:00 a.m. call. Nothing changes. The portfolio grows by about $73,780 this year from compounding alone. That's larger than many full salaries. It arrives without your effort. It will arrive again next year. Path A and Path B, age 40 and beyond. Path A, age 40. Net worth, $556,000. Monthly housing cost, $1,810, declining in real terms each year as inflation erodes a fixed payment. Portfolio, $284,600. Monthly investment rate, $2,100. In 18 years, the mortgage is gone. Housing cost drops to about $710 per month. If the home grows at 3% annually, and the portfolio compounds at 7% real with continued contributions. Net worth at 58 approaches $2.1 million. At that point, the portfolio supports roughly $84,000 per year using the 4% rule. Owning the home outright removes the largest expense from the monthly budget. The options are tangible. They are modeled. They hold under conservative assumptions. Path B, age 40. Net worth $1,088,000. Monthly rent $1,780. And rising without a cap. Portfolio $1,054,000. Monthly investment rate $3,600. If the portfolio compounds at 7% real with continued contributions. Total invested assets at 58 approach $3.9 million. At a 4% withdrawal rate, that supports about $156,000 per year. Rent at 58 is unknown. It could be $2,800. It could be $4,100. It depends on a city not yet chosen. A landlord not yet met. A lease not yet signed. That uncertainty is real. It doesn't invalidate the math. But it doesn't disappear from it either. The gap at 40, $532,000 in net worth. 18 years later, at historical averages. Both paths lead to wealth by any reasonable definition. The outcomes converge. Clear as throat. The experiences do not. Here's what no spreadsheet captures. Path A has driven the same route to work for 14 years. They know a neighbor named Carmen, who brought soup the week the water heater failed. The ceiling fan in the second bedroom still wobbles slightly. They never fixed it. They're not entirely sure why. It became part of the house. And the house became part of the life. After a while, the line between them blurred. It was difficult to tell where one ended and the other began. Path B has lived in 4 different cities. Each move was intentional. Each lease was a new option. They hold over $1 million in a brokerage account. And still can't say exactly where they'll be in 5 years. Some call that freedom. Some hesitate to define it at all. Both of them chose a system at 23. One system placed wealth into walls, time, and a fixed location. The other placed it into markets, flexibility, and a number that grew quietly in the background. Both systems behaved the way systems do. Both compounded. That was the only constant. That was the only guarantee. And the Tuesday after the decision still arrived. It always does. For both of them.